Hi, welcome to 5 Good Questions. I'm your host, Jake Taylor. I'm happy to welcome back to the show our guest today, Mebane Faber. Meb is a fan favorite and likely needs little introduction to most of you. He's the co-founder and chief investment officer of Cambria Investment Management. There he manages Cambria's ETFs, separate accounts, and private investment funds. Today we're going to be discussing his newest book, Invest with the House, Hacking the Top Hedge Funds. It's always a pleasure to chat with Meb, so let's ask him 5 good questions. All right, welcome back to the show, everybody. My guest today is Meb Faber. Hey, Meb, thanks for coming back on the program. I know it's you're a fan favorite based on the feedback that I get, and so it's always a pleasure to chat.
My pleasure. Good to be here.
So this newest book that you have out is called Invest with the House, and the idea is what, basically?
The idea goes back to almost 15 years ago when I was an undergraduate at University of Virginia and was taking a securities analysis class. And I wasn't a finance guy. I was actually an engineering and bio guy. But the point of the class was learning how to pick stocks. And it was taught by a hedge fund manager, former Tiger right-hand man, and Tiger Cub.
Right.
And the point of the class was you need to pick a stock, long or short, write a thesis on it, do a lot of value-added research, and each week there would often be guest speakers, so it'd be other hedge fund managers, journalists, or whatnot. And being the spring of 2000, to prepare for the class, because you didn't want to show up and start opining on some internet stock, and the manager actually owns it, and you look like an idiot in class. So we would print out the manager's holdings, and a lot of people don't know this. But institutional investors, if they have more than $100 million, have to report their holdings every quarter. So the holdings come out, it's called the Form 13F, it's 45 days delayed. So we would look at these holdings before class to at least get an idea for what these managers held. And so that idea kind of sat in the back of my head as I would listen to these managers talk, and they would go through all the research they had done and people they had hired, private detectives, and all these army of resources they have that we didn't have. And I said, why in the world would I ever try to compete with these guys? Why wouldn't I just try to piggyback on what their picks were? And being a quant, being an engineer, I could never get comfortable with that theory. I said, it was always interesting. It's like, reading the picks and Barrons. But unless I could go in and say, hey, does that 45-day lag, is it even possible to track these managers? Maybe they trade too much. So a number of years went by, and I think it was around 2006 when I grabbed an intern and I said, look, let's go start back testing this by hand. Let's see if it's even possible to track some of these star managers. And after many, many months of really tedious work, it turns out that there was, in fact, a lot of nuggets you could find, and it was possible to track a lot of these managers and piggyback on their top stock picks. So that was the genesis of the original theory of the book almost 15 years ago.
Huh. It's a perfect start for question number 1, which was the thing that was the most shocking to me about the entire book, really, was that the managers, I would have thought it would have been a perfectly reasonable strategy to look at their highest conviction picks and pick from those, because those are the ones that they theoretically did the most research on, they feel the best about, they have their most money in it, yet that was the worst performing of their top 10 picks. What the hell is going on there?
So there's a couple things to understand when you're looking at 13F. So first of all, it's mostly just their long books, so stocks they own. So shorts aren't going to show up, derivatives for the most part. So there's only a subset of managers you can really track in the hedge fund universe. You can't track any guys doing arbitrage, and you can't track guys that are doing some sort of pair trades where they're long GM but short Tesla. You can't track the commodity traders or the guys that use a ton of derivatives or Paulson's trade back in 2008. You can't track the high-frequency guys. And so what you really are looking at is a lot of the stock pickers, and the classic example being Warren Buffett. And so being able to track someone like Buffett and say, hey, can we track these holdings? So having spent so much time with this data, learned a number of things, and there's pros and cons to this approach. It's not just, hey, you can go just outsource it and forget about it, and it's this easy, magical holy grail. It's not. So one of the things you're talking about is says partially does the delay matter? And we found that for a lot of the managers we track, it matters, but just a little bit. So you get a slight degradation of performance by having to get that 45-day delay,
Right.
but it's not much. For the managers we tracked, I think it was around 1% a year. And you're looking at alpha for a lot of these managers of 4 and 5%. And so the largest holding, which is one that you're mentioning, and this was something Mark Yusko said to me when I just started doing this research. He says, Meb, this may work, but often their largest holding isn't that's in the filings is not their best idea. Rather, it simply has appreciated. So maybe it's gone up 20% a year for the last 3 years, or maybe it's doubled this year. So they just haven't really unloaded, or maybe they have unloaded it and the 45-day delay just hasn't happened.
It hasn't shown up that they've trimmed it.
We found that so of the top 10, we would often look at the top 10 holdings because that's where the majority of the managers' exposure was. So hedge funds are a lot more concentrated than mutual funds, which is a good thing because you want the bets, concentrated bets. But the top holding we often found was one of the worst of the top 10. So if you're looking at a lot of these managers, you could either pick 2 through 5, 2 through 10, put together a group of 5, 10 managers if you want, and use it even as a screen or totally outsourcing your portfolio. But getting rid of the top one is a totally reasonable thing to do.
So that's a good segue kind of to question number 2 is if you really do believe in a 13F copycat, what are a few of the things that you can do to make it more systematic, let's say, unless you just kind of throw in a dart or
Yep.
you know, maybe thinking you could add your own research on top of that.
One of the benefits of this strategy in the beginning of the book, we say, look, there's 2 questions you have to answer to even read the rest of this book or believe in it. And one is you have to believe that it's possible to beat the market. And if you don't, just go ahead and stop and go buy the S&P. Mm-hmm. 2 would be that you can identify these managers ahead of time. Of course, you can identify them now in retrospect and say, of course, we should have allocated to Buffett for the past 40 years. But we say, can you identify them ahead of time? And one of the biggest pieces of research I feel like it's fairly well understood is that active managers do beat the market, but that's gross of fees. So once you take out the fees, active managers don't beat the market in general, and that's kind of a mathematical just certainty.
Right.
And so one of the beauties of this approach is you're not paying these managers often the 2% management fee, 20% performance that most hedge funds charge. So being able to avoid that fee is already a huge source of alpha. So, what a lot of people want to do, and the same thing they do this with that asset allocation portfolio, is they think that their emotional or whatever sort of mental models they have is better than the market or better than what these guys are picking. And so people say, it's probably not time to be investing in commodities or bonds because we all know interest rates are going up. Or in this case for the stocks, they'll say, no, I'm going to screen these 2, maybe avoid these 3 names. I don't like them. And invariably what's going to happen, those 3 names are going to go up the most. Mm-hmm. But if you're going to use this strategy where you're outsourcing it, then you need to blankly outsource it because the value add with these guys is you're giving them a go anywhere mandate. And so the ability for these guys to pick their stocks, let them do it. You pick the managers, let them pick stocks. Now, you can use it if you're a small cap manager and you say, look, I'm going to use it to just see where these guys are picking small caps. That's totally reasonable. Use it as a screen. Mm-hmm. And what you want to, so either approach is valid. What you want to avoid is pretending to do one, and then when they're down 50% saying, no, I'm done. I don't want to do this anymore. I want to pick the ones that I believe in, because that gets into the behavioral issues of chasing performance, which is of course a big no-no.
Yeah, exactly. So bastardization of it is often worse than picking one or the other.
Right. So
going back to that kind of 2 and 20 for question number 3, with the proliferation of ETFs that we're seeing, and I think it's perfectly reasonable that you could have a systematic approach to 13F in an ETF potentially, mm-hmm. And then why would anybody ever pay 2 and 20 then at that point when you could pick the ETF for some probably considerably less percent? What do you think about that as far as?
Whether it's an ETF or even doing it on your own, most brokerages you can get away with charging or paying commissions of very little. There's even a brokerage now, Robinhood, that
It's
charges
free, right?
nothing.
Yeah.
So um, you don't have to pay the high fees, we think. And there's a number of problems with these hedge funds. So first of all, if you wanted to invest in Seth Klarman's Baupost or Par Capital or a lot of these guys, you can anyway. They're
Right.
closed to new money. So unless you have 10, 50 million, you're not going to be able to invest. Two is the high fees, but there's other problems with these hedge funds. So back in '08, a lot of these hedge funds locked down your money and put up gates.
Mhm.
But one of the least talked about, but most significant, is the tax inefficiency of hedge funds in general. So unless you're a tax exempt investor or like an endowment or a tax exempt account, hedge funds are horrifically tax inefficient because they trade a lot. So if you're an individual or you're using ETFs, which structurally are fairly tax efficient, you're avoiding a lot of these problems. Now, ETFs is just a structure. Someone could charge you 3% on an ETF if they wanted to anyway. But you could also do it on your own. And so that's part of the fun and part of the benefit. And that's why in the book we do 15 profiles, I think, of funds that we like. In the appendix, we did another 10 or 15. I can tell you three of the top, my favorites are Warren Buffett at Berkshire, Seth Klarman's Baupost, and Par Capital. And so just picking out some of your favorites and tracking and following those managers is probably, and in some cases in the book we found out that the returns of the clone, is what we call the 13F portfolio, was actually better than the underlying fund. And that's because of that degradation, right?
Yeah.
The cost of paying the fees. So that's a pretty cool finding that you can outperform these managers just by
purely based on not paying them so much.
Right.
Yeah, that's pretty crazy. So question number 4, one of the interesting data points that I saw in the book was that only 25% of the stocks are responsible for all of the market's gains, which I think might surprise a lot of people. So what implications does that have for us as potential stock pickers versus being indexers?
So when you think about indexing, so the S&P 500, for example, or just the broad market, it's market cap weighted, meaning the largest stocks have the largest allocation. So right now, Apple, the largest stock, or Google, all these companies that have these 3-4% weightings. And that's a great first way to invest. When indexes were investing, that is the market. So you were getting the market. But that's simply capitalism. And if you think about it, as these stocks get bigger, they invoke some competition.
Sure.
And so there's now companies in Asia and everywhere else in the world saying, these guys are making billions of dollars of iPhones. Why don't we make cool phones too and also make billions of dollars? That sounds
Samsung.
awesome.
Yeah.
Right. And so you get a target on your back. But that's beautiful. That's creative destruction. That's what makes this world go round and makes it capitalism an awesome system. From an investor standpoint, and Research Affiliates has done a lot of research on this. Monish Pabrai actually published something on this in one of his books, where if you look at the largest company, and we have some posts on our blog, in the stock market, and you simply invested in that stock, that underperforms the broad market by about 3% a year. Mm-hmm. And so you don't want to be investing in the largest company in the S&P. It also applies to sectors. You don't want to be investing in the largest company in any sector. It also underperforms by about 3% a year for the next decade. And so breaking this market cap link, so doing any other weighting methodology, it doesn't matter if it's equal weight, fundamental weight, value weight, whatever it may be, it should beat market cap performance. And so going back to what we think about, and there's a great paper from some friends at Longboard Asset Management, I think we mentioned in the book, called The Capitalism Distribution, that talks about how the big winners make up the majority of your returns. And look at last year, people were talking about the FANG stocks.
Right.
And the 5 stocks, Facebook, Amazon, Netflix, Google, accounted for a massive amount of the gains of the index. But that's the way that it should work, because you have these huge winners, and as companies go down or lose money, they become a smaller and smaller piece of the pie. And I would cite the stats in the book. I think I'm going to get it wrong, but I'll try. It's something like 2/3 of stocks from this Longboard study, going back to, I think, the 70s or 80s and the Russell 2000, 2/3 underperformed the index. Roughly half had a negative return over their lifetime, and something like a quarter basically went to zero. And this isn't penny stocks. These are the top, stocks in the U.S. And what this is going to show is there's a relatively minority. And so different people interpret this different ways.
Yeah.
The Vanguard guys will say, well, that's the beauty of indexing. You should index because if you miss, Apple or Amazon or these big winners,
you can't catch up. Yeah.
The trend followers will say, no, this is a great example of trend following. This is why you should be a trend follower, because you'll always own the winners and you'll cut your losses short on the losers. There's a lot of takeaways. But one is certainly that market cap indexing works, but we don't think it's the best you can do. We think you can do better. So as applied to investing with these managers, a long-winded answer, if you say, I'm going to take the top 10, but then you say, you know what, I'm going to exclude these two energy companies because we all know oil is going to zero. And sure enough, they go up 50, 100% and generate all the returns. So it argues for having a concentrated portfolio, but also having enough bets. That's what a quant would say, enough bets out there to cover the possibilities. So having 3 stocks, that's probably enough. Having 500, that's probably too much. But probably if you're going to track some of these managers, certainly having somewhere between 10, 20 to 100 or even 50 is probably plenty.
Yeah, that kind of reminds me of Joel Greenblatt had some studies about when he let people choose, they could flag out certain stocks that there's too much hair on this. Who would want that in their portfolio? And everybody underperformed even just the model portfolio.
And this is such a reason why value investing in general works is, whether you're value investing in stocks or countries, as we do, and people are saying, hey, 2 years ago, think about it, or last year about people talking about investing in Russia. My God, you could not get a single bullish reason to invest in Russia. And certainly right now, the example would be Brazil. And you can always find reasons to invest in the ones that are near all-time highs. Till recently, the U.S. was. So, but that's part of the reason that it creates opportunity, is that we're all human and emotional and have all the emotions of greed, fear, and envy.
Yeah, and we love stories. So, so question number 5: if you had to pick one of the managers from your book to manage 100% of your net worth, and you couldn't switch out, you just had to go with them, who would you go with? And keep in mind too that you need to, obviously Buffett's a great choice, but you might only get so many years of Buffett left, so you need to kind of choose a little bit of longevity as well.
Let me make a comment on picking these managers that I think is instructive, and then I'll give you my pick. First of all, here's the beauty and the challenge of this strategy. So let's look at Buffett. So Buffett has outperformed, if you do his top 10 clone, since 2000, that's outperformed the market by about 5% a year. So he's done about 9.5%. Market's done around 4% from 2000 to 2015. And that puts him in the top 98% of all active stock mutual fund managers. So he's beaten 98%. And we've all known Buffett's been a great investor. So people would say, why would you not have just invested in Buffett? In the late 90s, no one wanted to invest in Buffett because he was doing terrible and all the internet stocks were the rage. Mm-hmm. And this clone actually has outperformed Berkshire by about 1% a year over that period as well. But they're close enough that it's kind of a wash. And so, but if you tease out the returns and look at them on a yearly basis, his top 10 stock picks, rebalanced quarterly, has underperformed the market 6 of the last 7 years. And that's pretty astonishing. So how many people out there could say, you know what, I'm going to allocate to this manager and I'm going to sit through 6 of 7 years of underperformance? Zero. There's zero individual institutional investors that would sit through that. But that's part of the alpha of investing with someone like Buffett is, and it's hard to get your head around this, say, all right, you're going to be in the top 2%. You're going to beat 98% of funds, but you have to sit through 6 or 7 losing years to the S&P. That's really, really, really hard to do. And part of Buffett's alpha is that he sticks to his style. Mm-hmm. And so as you think about all these managers, and this leads up to my favorite right now, which has always been Seth Klarman's Baupost, I tend towards the managers that do something a little weird. If you look at the stock names, usually for some of the managers I like, whether it's Parr or Carlo Canal, and you look at these names and you say, huh, I've never even heard of half these stocks. Buffett, you get IBM, Coke, all the famous names, and that's
Right.
great. But a lot of the names I like are ones that they end up investing in some sort of weird stuff. And so we've written a lot. We've been talking about Baupost for the past 10 years, and Seth Klarman's the main manager there. And this is also interesting because most of their book is real estate, private equity, and debt. So they manage whatever, let's call it 25 billion. Only a fraction of that is equities. But the equities portfolio, like Buffett, has outperformed by a mile since we started tracking them. However, it has periods like Buffett, and Munger says this, if you can't sit through a 50% loss, you shouldn't be investing in stocks.
Yeah.
And so Baupost the long book got hammered in 08, 09, and is getting hammered now. And so you have the opportunity right now to invest in Seth Klarman's stock book at half off. He's in a 50% drawdown. So we think it's a really cool time to be investing in Klarman's picks, one of the top unquestionably valued investors of our generation. I got a handful of others in the book that we like, but he's probably my desert island favorite if I had to choose one value guy to copy.
Yeah, and I mean, if I've seen some recent studies about how poorly value has underperformed the last 5 years, and it does seem like a compressed spring potentially at this moment.
Yeah, and typically value a lot of times will outperform during bear markets because during bull markets you get a lot of the junk that is rallied, as in the case of this bull market. And each bull and bear has its different characteristics where they have somewhat of a different feel and different
flavor
to them, right?
Yeah.
And so you've seen it in this short period already in 2016, perhaps, but usually the high quality value names will outperform in a bear. Doesn't mean they're not going to go down 50%, when times are really horrific, but in general, I think Berkshire is down to a price to book of around 1.3, which is getting into the buyback zone. I would love to see Warren and company start to put out some big buybacks on Berkshire. That would be fun to see. But yeah, who knows? I mean, there's a season for every investment strategy, and we spend a lot of time thinking of this. And I actually just did a post this week on it. Research Affiliates had a great post where they look at factors, whether it's value, low volatility, quality, and the flows change a lot of these factors so that they have good times, whether it's growth or value, they have bad times. But thinking about the fat pitch of when to invest in value and when to maybe step aside. And we think low vol is a good example right now where so much money is rushed into it. Investors may want to take a step back and say, hey, look, low vol stocks are actually really expensive. Does that make a lot of sense? And dividends have been kind of in the same ballpark last few years.
Reach for yield.
Yeah, the reach for yield. Exactly. When you're in a 0 to 2% yield world, dividend stocks look good, but you need to have a valuation filter. That was the long-winded answer to say. I could have just said Seth Klarman and been done.
Moved on from there, but
right.
Yeah, I found it interesting in the latest Berkshire letter that just came out. He set his target at 1.2% of book value, whereas before I've seen him say 1.1%.
He moved it up a few years ago, and I don't know exactly when it was, but it's been in that 1.12 range over time. But I haven't read the letter yet. That's on my to-do list for today, so I'm excited to take a look.
Yeah, I think why he does that is because of the accounting treatment of the private businesses now.
Okay.
Book value is understated compared to what it was when everything was marked to market. When you had a bigger security portfolio kind of dominating the value. But yeah, it's interesting to see him kind of adjust that up a little bit. But yeah, I'd love to see it get down there, and you feel pretty good about buying it at 1.2 if you knew you had that floor,
Sure.
So bonus question we always ask, and this is for a book recommendation, typically something that's underappreciated or maybe a little under the radar.
I'll give two. And one I probably gave last time, if you asked me. It's the same thing I often give. But people still don't read it. It only has like 12 reviews on Amazon or something. So my favorite investing book is Triumph of the Optimists, and written by some British professors. It's expensive, So try to borrow it or get it at the library. But it's a beautiful coffee table book. But if you want the free version, it comes out every year from Credit Suisse. It's called the Global Investment Returns Yearbook. They put it out yearly. You can find it online. And it comes out maybe 2 weeks ago. So the new one just came out. It looks at stock markets going back 115 years, not just in the US, but China, Russia, everywhere around the world, but also bills and bonds and currencies. And it's just a great historical review of returns. And you should also go ahead and read the last 10 year of updates, because each year they tackle a different subject. This year they were tackling low interest rate environment, as well as what happens when interest rates go up, et cetera. And this will segue into our recent paper, so I'll throw in a bonus. We just did a paper called something like Finding Yield in a 2% World. And I wrote it last fall. I probably should update it, Finding Yield in a 0% World, because a lot of European bonds are
negative world,
0 to negative, which is crazy to even think about. But a lot of people don't know that foreign bonds are technically the largest asset class in the world, but very, very few Americans in particular allocate to foreign bonds. And so thinking about a value approach the same way that value investors think about a value approach in equities, but applied to bonds, and it's known as carry historically, but is a very simple way of being able to have a fixed income approach that actually beats the market cap weighting in fixed income, which is actually allocating to those that have the most debt outstanding, which is a little bit of an odd way to think about it. But it's fun little papers. So that's 2 that are free that you can get online, and both are worth your time.
Well, Meb, perfect. I love those recommendations. I'm going to check those out myself.
Great.
And thanks again for coming on the show. It's always a pleasure to chat.
Looking forward to doing it again.
All right. Keep making good books, and you can just keep coming on the show whenever you want.
All right.
All right.